And I think it's an important thing to look at to try to understand both sides of this case. So let's look at what we're talking about. Here's the actual case, and this was submitted, as we can see, December 18th. So today's the 20th, so 2 days ago. And it is the state of Tennessee versus BlackRock. And I think there's some interesting things to go over here. Of course, they describe the background and using basically BlackRock has been at the forefront of using aggressive strategies to push controversial ESG goals across the assets that it manages. So that's the first allegation. And it says BlackRock marked many of its funds as devoid of ESG considerations and has admitted that ESG aims, in particular, radically reducing portfolio companies' carbon outputs, do not provide an indication of current or future performance, nor do they represent the potential risk and reward profile of a fund. So they have some funds that are devoid of ESG considerations, according to them. And here it says, for years, however, BlackRock has misled consumers about the scope and effect of widespread ESG allegation or activities. This is the allegation. And it says BlackRock's conduct concerning the marketing or sale of investment products and services constitutes deceptive acts and practices under the Tennessee Consumer Protection Act. And so the state of Tennessee and the Attorney General are now bringing this civil law enforcement proceeding to stop BlackRock's rampant ESG evasion and protect consumers. Now, this is a 70, as you can see here, it's a 73-page document. I'm not going to go through every page of it, but I am going to highlight some of the key considerations. So bear with me as I go through some of this. So let's go back and look at the introduction. It talks about how it's managing about $8 trillion of assets under management, and it employs 19,800 people, and what a massive company. And of course, it provides all kinds of investment products to more than 190,000 financial advisors around the world and 35 million Americans. And the funds hold shares in portfolio companies on behalf of BlackRock. So it's an important thing to understand about a mutual fund company. They are owning stocks on behalf of their clients who give them the money. So let's now get into where it talks about the ESG. This is sentence number 5 or paragraph number 5. As a leading investment firm, BlackRock has been at the center of the rise in ESG-focused investing. And it's investing with a focus on achieving or signaling certain environmental, social, and governance priorities. And at a high level, ESG often aims to promote progressive policies, particularly when it comes to climate and carbon-related issues. And I think for the supporters of this, they'd say, absolutely, that's exactly what they're doing and what they want to do. Given its large size and prominence, BlackRock has led the charge in promoting these aggressive ESG goals. Most relevant here, BlackRock ESG activity has involved committing to fight climate change. Okay, so this is an important part of the allegation. So here, what they're talking about is BlackRock joined activist organization Climate Action 100 Plus and the Net Zero Asset Managers initiatives, thereby committing to use the weight of all assets under management to push ESG objectives on the companies in which the funds owns shares. So this is an important part of the allegations of this particular charge, and that is that by joining these activist organizations, they've committed BlackRock as a company to following certain climate and ESG type of initiatives. The key to the argument here is that it would be impossible for BlackRock to say that parts of its funds or its ETFs are not ESG driven while others are, if at the company level they've committed to these goals. And that really is a crux of the argument. And BlackRock's engagement as a shareholder in key voting actions likewise have centered on climate change consideration. And that's constituting, we can see, with climate and natural capital constituting BlackRock's #1 shareholder engagement factor in 2020 and 2021. Now, top leaders have acknowledged the company's focus on driving ESG, and they cite a article which says the significance of ESG engagement. That's the title of the argument. And what did they say in there? So this is one of the managing directors here. He's identified a purported need for conscious decisions regarding how ESG engagement fits into the company's investment strategy, which he noted can help avoid disengaged shareholders, enabling companies' poor management of ESG matters. And then there's Larry Fink, the CEO, has stated that BlackRock is asking companies in which it holds investments to set greenhouse gas reduction targets, which BlackRock will police through voting and engagement. We've already seen on many occasions Larry Fink come out and talk about the importance of ESG and the importance of what he calls stakeholder capitalism, and the idea of that BlackRock has a responsibility and some obligation to try to use stakeholder capitalism to get companies to change their behavior. And so now let's continue on, and let's go down. I'm going to go down to another section. Larry Fink, in June, it says the ESG debate came to a head in June 2023 when Larry Fink declared he was discontinuing the use of the term ESG. Fink further stated he was ashamed to take part in what he deems an overly politicized debate on the issue. And I just, there was just a lot of heat from the different political factions in America on it. And I suspect he got himself caught up in that. So this is another key crux of it, is that the shifting public and political dynamics around ESG have left BlackRock in a bind. On one hand, BlackRock's success and growth depended on retaining and growing its AUM, its assets under management. This in turn requires appealing to a broad base of customers, many of who do not want their funds or investment managers engaged in ESG related activities. Coming clean to consumers about the extent to which ESG commitments permeate its investment and engagement strategic and strategies would thus risk BlackRock's business success. Now, on the other hand, BlackRock remains a member of these organizations that were mentioned earlier, which demand sweeping ESG commitments. Now, this is an interesting point. Other similar companies like Vanguard have withdrawn from these groups to provide clarity to investors regarding their position on climate change risks. So let's talk about that for just a second, because it's a critical thing. First of all, everybody cares about the environment, and everybody wants to see a healthy and clean environment. The question is, how do you get there? Now, one of the things that society's trying to do is get there by using investors' money and investor influence to influence the management of companies. The problem with that is that there is a fiduciary duty that we have in the world of finance, and that is to protect the shareholder value and try to maximize the value of the money that's been given to you. When people are giving you money, they're giving it with a certain mandate. The mandate is usually to do the best, to get the best financial performance. There's nothing wrong with having a mandate to get the best, a balance between, let's say, financial performance and environmental, social issues. Anybody that wants to sign up for that can definitely sign up for that. But not everybody wants to sign up for that. Some people would say, no, I don't really want my asset management company trying to enforce the ESG policies. So it's, of course, comes down to voluntary ultimately. That I would say the argument you could say is that the asset management companies are going to, over time, have ESG and non-ESG portfolios in ETFs. This is my prediction. And the result of that is that they can't make a claim of compliance to an organization like CA 100 Plus or Net Zero Asset Managers, because that would bind the whole company. So they would either not be allowed to join that, or they may have to separate the company into an ESG asset management company and a non-ESG asset management company to get around this. But right now, BlackRock's caught in, a situation that we haven't seen the response from BlackRock yet. And I look forward to understanding that. So it says BlackRock's continued membership requires BlackRock's ongoing commitment to pushing aggressive carbon reduction strategies across all assets under management. And it's that final part, all assets under management, that they're arguing in this suit. Pulling back from its previous promise to ESG groups risks drawing unwanted negative attention and loss of business from the powerful investors, media members, and politicians who have demanded that firms prioritize ESG considerations. So rather than risk either downside, BlackRock has chosen a third way. And this is the claims in this case, and that is that BlackRock is deceiving consumers about the company's extensive commitment to fulfilling ESG aims. There we are. That's really what is critical. Now, here they talk about the pattern of deception has played out primarily in two parts, and that is that BlackRock has falsely conveyed that certain of its funds do not incorporate ESG considerations. So that's the first claim, right? And saying that. And here we can see is that BlackRock also says that it does not dictate to companies what specific emission targets they should meet. And here, Larry Fink, in a 2023 October interview, Larry Fink says, he reiterated that everything we do on behalf of our clients and everything we do is with the purpose of financial returns. There's not one thing we have ever done, whether it's ESG or any other issue, that's in the pursuit of financial returns. That's our fiduciary responsibility. We live by that every day. So that was his particular statement. But the point in this lawsuit is that BlackRock's policies and voting records show that ESG considerations are they in fact drive portions of the investment strategy, including the non-ESG funds. And that, again, is part of the allegations here, right? So it says BlackRock has pledged to comprehensively implement a stewardship and engagement strategy with a clear escalation and voting policy that is consistent with the ambition for all assets under management to achieve net zero emissions. So I'm going to skip ahead. You get the point on that one. And the point that they make is BlackRock's voting and engagement steps have been consistent. Although BlackRock may have specific reasons to justify certain votes, it nonetheless has in many instances voted against portfolio company management's recommendation in favor of climate-related shareholder proposals. BlackRock continues to vote its shares to push companies to set emission targets aligned with net zero. Here we can see they mentioned that including in 2023 votes at Berkshire Hathaway and Newmarket Corporation. Likewise, BlackRock has repeatedly voted to pressure companies like Chevron Corporation, Walmart, and United Airlines Holding to align their lobbying with the carbon emission goals of the Paris Agreement. Which, again, if we go back to the principle, that's fine, right? If that's what your clients want and investors want, there's nothing wrong with satisfying that. But just be very clear in what you're optimizing for. And I think that actually one of the most significant things in the ESG space is clarity. For instance, there are companies that say that we subscribe to stakeholder capitalism. I would argue that they need to make that clear in the company bylaws so that an investor can come along and say, okay, this is a stakeholder capitalism company, and this company is a shareholder capitalism company. Nothing wrong with that. State it clear up front. I think that's one way of getting transparency. Of course, stating it clear may not be what everybody wants to do in this case, but I would argue that that is a significant item. Now let's get into the second allegation that they make, and that is that BlackRock has overstated the extent to which its ESG aims bear on companies' financial positioning and performance. The problem is most acute in the context of ESG funds that, according to BlackRock, expressly take ESG factors into account when selecting investments. BlackRock has repeatedly represented that considering ESG factors in these funds creates purported financial benefits to investors. Now, that's kind of hard to believe, because if there was financial benefits, you would basically see the companies doing that already. So BlackRock's prior ESG fund disclosure reported to consumers that sustainability characteristics can provide insight in the effective management and long-term financial prospects of a fund. I want to talk about this because it's another part of the allegations, and that is that that you're going to get better performance by investing in an ESG fund. Well, that just doesn't make sense, right? Because for a couple of reasons. Ultimately, if companies, the objective of a company is to maximize profit. They're doing everything they can to maximize profit. If they saw an ESG related activity that their company could do, like solar panels or whatever, they are constantly looking for ways to increase their profit margin and maximize profit. And therefore, they would implement it. The reason why they're being pushed to implement through ESG is because it costs some money up front to do what the people that are pushing them believe is the right thing to do for the environment. And so in the end, it is something that the companies may not be doing because they're not profiting from right now. So therefore, if they do it, it would mean lower profit. The second reason why it doesn't make sense that you would get outperformance by investing in ESG funds, besides a temporary outperformance that would come if everybody rushes into ESG funds and says, hey, that's the fad of the day, I want to be in ESG funds, that could push up the price of ESG funds for a period of time. So there's a momentum factor that could cause outperformance. But long-term financial prospects, long-term outperformance, highly unlikely. Why? Because you have ESG selection criteria, and some companies rank high and some companies rank low on those criteria. Naturally, you would exclude the low ranking ones from an ESG portfolio. And if you did, you're excluding the investment universe. Every time you reduce the investment universe, it gets harder and harder to outperform. And so I would argue, and it also increases risk. If a fund normally has 100 stocks and it finds out that it wants to set up an equal fund, but an ESG fund, they're not going to have the same 100 stocks. They're going to look at those same 100 stocks and they're going to say 20 of these we don't want in the portfolio because of ESG criteria. And the end result of that is that they're going to get higher risk because you have less diversification, and they're going to get lower return because you have reduced your options of where to pick stocks from. So let me just go ahead to a couple of other points, and happy to take any questions if you have any. But let me just go into, let's just see. Hold on. Let me look. So, okay. So here we can see, getting into the allegation, BlackRock is bound by fiduciary obligations when managing its client's assets. And it claims to seek the best risk-adjusted return for client portfolios within the mandates given by the clients to help them meet their investment objectives. And that's where you can say that it's a conflict ultimately with ESG. Now, this is not necessarily a conflict if the client said, I am happy with an ESG fund and I understand the impact that would have on risk-adjusted returns, then no problem. BlackRock maintains a significant sales and marketing presence that's focused on establishing and maintaining retail and institutional investment management relationships. All right. And BlackRock's, let's see, hold on. We'll go forward. It's just talking about the size of the company, how it's reaching the market, and that it's competing in the consumer space. By showing that it competes in the consumer space, basically it's saying that it's under the jurisdiction of the Tennessee district attorney. And so here it says, BlackRock commits to pursuing extensive ESG goals. Nearly 2 decades ago, the term ESG was coined. They give the background. And then basically, let's see. So they're talking about engagements, right? And what they're talking about here is these holdings give the largest investment managers enormous power and influence, meaning holdings in the stocks that they're investing in, because these shares can be voted at company meetings to support or oppose directors, management, and shareholder resolution. BlackRock holds a large amount of shares and voting rights on behalf of its clients. Now, that power also extends to engagements, something that they talk about, in which investment managers meet with companies behind closed doors to discuss the investment manager's viewpoints. And these engagements come with the implicit or explicit threat that if a company or director fails to address the investment manager's concerns, the investor management could vote all of its shares against the company or director, potentially determining the outcome of a vote. And engagements also allow investment managers to influence company policies without taking any public action and without any shareholder vote. Finally, BlackRock's power extends even beyond engagements to influence it through the influence it exerts through public statements, such as Larry Fink's statement at conferences or his yearly newsletter. I remember seeing the one where he committed to stakeholder capitalism and challenged everybody to do that. So the point that they're saying is, for these reasons, BlackRock has long been a top target of climate activists, because they know if BlackRock gets on board, hey, they're going to get some of these things done. And that is a little bit of what's going on. So I'm going to BlackRock. They explain a particular case here and talk about different groups and different companies. But here, let's go to the next allegations that we can get. Hold on one second. Okay. BlackRock makes deceptive statements, disclosures, and omissions about its pursuit of ESG. And it says the funds BlackRock offers to investors generally fall into two categories: funds without any explicit ESG or sustainability labeling or objectives, and funds with explicit ESG or sustainability labeling or objectives. And they go through those different types of funds, and investors can choose. But the point that they're saying is BlackRock has made and continues to make deceptive and misleading representations and omissions regarding the listed non-ESG funds. Through these deceptive statements and omissions, BlackRock has downplayed its activities and its roles in aggressively driving the transition to carbon, to net zero. So again, the allegations are related to the idea that that BlackRock can't commit as a company to climate goals, because those commitments would end up falling into the non-SG company funds as well. This is a interesting case. It's, like I say, it's about 73 pages. I've gone through some of the basics of the case, but I think that from that perspective, I think it's an interesting one to watch, to see what's going to happen with the judgments on some of these things. I think that some of the allegations that they make can make sense, right? That if you're saying you're non-ESG, well, then you need to be non-ESG. And so let's just look at what they call the prayer for relief. Of course, being in Tennessee, a religious background probably, they're looking for a prayer for relief. So they pray that this complaint be filed without cost bond as provided by the Tennessee Code, that the process issued and served upon BlackRock requiring it to appear and answer, and that this court adjudge and decree the BlackRock is engaged in the aforementioned acts or practices that violate the Tennessee Consumer Protection Act, and that pursuant to Tennessee Code, all this detail of the code, this court permanently enjoin and restrain BlackRock from engaging in the aforementioned acts or practices, and that this court makes such orders or renders such judgments as necessary to restore consumer confidence, consumer and other persons the money and property lost as a result of the alleged violations. And this court makes such orders or renders such judgments as may be necessary to disgorge the net profits and ill-gotten gains that they've gotten in violation of the law. And this court orders BlackRock to pay a civil penalty, and that this court enter a judgment against BlackRock in favor of the state for reasonable cost and expense of an investigation and the prosecution of this action. And that all costs, including discretionary costs in this case, can be taxed against BlackRock, that a jury be impaneled to hear and decide all appropriate matters, and that this court grant the state such other and further relief as this court deems just and proper. Again, this is filed December 18th, 2003, just in time for Christmas, submitted by Jonathan Skrmetti, Attorney General and reporter, and signed by Brandon James Smith, Chief of Staff. And that gives you a picture of this BlackRock case. I thought it's an interesting one, and it's worth going over to understand what's happening there. If you got questions, comments, ideas about this, I'd love to hear them in the comments. So feel free to leave any comments that you